Hello and welcome to this latest programme from Baillie Gifford, part of our ongoing series of webinars with the managers of its investment trusts. I'm Richard Lander of Citywire, and today I'm talking to Douglas Brodie, one of the co-managers of the Edinburgh Worldwide Investment Trust. So a very warm welcome, Douglas. Thank you for joining us today. And I noticed the title of today's session is A New World Order and the Next Generation of Companies, I beg your pardon, set to prosper. A very bold and definite title. From your point of view, what is changing most dramatically in the global environment, and why does that matter for the trust that you run?
Sure. Hello, everyone. Look, I often think investing is really about trying to distinguish between constants and variables, and those constants are those things that you can clearly incorporate into your investment approach, and the variables are things that you must adapt to. And I think really over the last 5 years, we've seen this sort of strange blurring really of the lines between those two things. Those perceived constants of globalization, harmonious trade, it began to make way for real sort of geopolitical tension, that sort of east versus west axis, even to the extent that now really feels like the norm. More recently, you've had the arrival of the Trump Mark II in the US administration, and I think investors have really been forced to question things that they've generally, again, been taken as a given, be that free trade being replaced by tariffs, recasting of alliances, a real challenge to US institutions, be they federal, judicial, or indeed academic. So it's been a potent mix for sure. And markets have had to grapple, I think, with an awful lot. And I think at times they've found it really hard to distinguish what is policy and what is posturing. So look, there's been a period of uncertainty, possibly the greatest challenge to that whole notion of US exceptionalism, seemingly a willingness by the US to give up being the sort of de facto global superpower. Stepping back from all that noise, what are you left with? So you've still got geopolitical simmerings, new alliances being cast, a real pressure, I think, for more self-resilience, both at the corporate level, through supply chains and reshoring efforts, but also at the national level, the importance of access to technologies, key technologies or defense. All that is occurring on the backdrop as we keep hearing of AI-based technologies really set to make a lot of deep change. So that's creating opportunities and challenges. So I think it's all of that together is the melting pot for this new world order. If you turn that towards EWIT, so what do we do? We are focusing on innovative entrepreneurial companies, those companies out there applying technology and the best human capital to really solve big problems. So it's companies dynamically building for the future. So to that extent, we think they really carve their own path forward. They tend to be the master of their own destinies much more. They carry less overt cyclicality. They tend to be more nimble businesses. They're almost like the speedboats to the oil tankers of the larger, bigger businesses.
Yeah, I mean, to that extent, you've long been focused on these early stage disruptive businesses. And you mentioned the speedboat and the oil tanker. So it's your firm belief that these are the companies that are going to affect that change in such a slightly strange world as we have at the moment.
Yeah, no, I'd agree. It is becoming a slightly strange world. I think we are entering a period where, frankly, growth will be harder to come by, whether or not that's through like a cyclical hit from tariffs or just the pure constraints of a deglobalizing world. So it puts, I think, a primacy on companies that are building, innovating in areas of robust and growing structural demand. So that may be companies that are unlocking that demand through their own technological progress. So take SpaceX as a clear example of that they are transforming and radically inducing demand through a technological shift. You may see that demand in areas that really just sit outside of the current angst. So a lot of healthcare, if you come up with innovative novel therapies that treat untreated patient populations, you will find a receptive audience. There will be companies, frankly, that are radically transforming their offerings by infusing AI, and we've got examples of that. But there's also companies that can cater directly to this changing world. And I think for me, this is probably the bit within EWIT that has changed the most over the last 3 to 4 years. So I think we were very in tune with that ratcheting up of geopolitical tensions. Companies coming up with technologies that could really cater to a less secure world, a more resiliency craving world. So we have a holding in a business called AeroVironment, which does drones. We've seen the importance of that technology in Ukraine, and now every country wants access to leading drone technology. We have an investment in a business called Echodyne, which is doing very low-cost radar for threat detection, so radar units, basically the size of iPads at radically lower price points. We have a relatively new position in a business called Xometry, which acts as a marketplace between people that want industrialized parts and the milling and machining companies scattered around the US and frankly globally who could supply them. That's very much in keeping with companies now looking to reshore demand and do it in a very highly value-added way. And clearly with the exposure that we've got to that sort of commercialization of space, SpaceX, Astranis would be another one. That's almost probably the most geopolitically important frontier for the next decade. So yeah, we think we're well positioned to cater to either ongoing demand or where that nature of demand is moving to.
Excellent. Right. So just to turn back to the trust itself, rather than the companies you invest in, it's been a painful few years for your investors and for you as well, I am sure you feel it. What happened and why do you think we're at a pivotal turning point now?
Yeah, as you highlight, the last couple of years have been challenging. It's been well characterized in terms of the high inflation, the high interest rate environment, and for a strategy that focuses on young, innovative companies building for the future, it's frankly been the perfect storm for us. We've also acknowledged some mistakes during that period. We feel this. We are shareholders too. I have a significant portion of my wealth tied up in Edinburgh Worldwide. But there's an element of all that things that concocted to make that backdrop, that difficult backdrop. We feel that's very much in the rearview mirror. So you've had pockets of enthusiasm in stock markets, but as it's been observed, that tends to be quite narrow. It tends to be centered on all the AI infrastructure, the so-called Magnificent Seven, and that has frankly absorbed a huge amount of risk-seeking capital from equity markets. It's a theme, frankly, that's been, I think, worked very hard. So look, they are great businesses, but do they make great investments from here? And that's probably the debate that the stock market is having. We sense things are turning. Investors are having to look more broadly for returns. That they have to, because the themes that they've been working with have been quite heavily exploited. What we see when we look out there is really that those frontiers for innovation are very much alive and well. AI and all that infrastructure, look, it has a role to play in that, but those frontiers are just far, far, far broader. We see that shine through in the metrics of the portfolio, markedly superior growth rates at both the revenue and profit level. We see it building in the narrative behind the companies, and frankly, we see it in the progress that they're making.
All right. You weaved in there that you have made mistakes. Every good portfolio manager has to admit to that. But you've also talked recently about process changes that you introduced at the end of last year. Can you tell us a bit more about those and how they've made or you hope they'll make the portfolio more resilient going forward?
Yeah, so through last year, we frankly did a lot of soul searching around, had we made areas, could we adapt for the future? We worked closely with our internal risk function around that. We evaluated basically a decade's worth of data, looking back at pretty much every decision that we've made. And I think that, yeah, there were some clear lessons from that. So really, the financial immaturity across our portfolio of some of our most early stage businesses, that was increasingly a correlating source of risk. And really, just to distill it down, that the earlier stage companies in aggregate had been more of a drag than we were expecting. And the returns that we had delivered had more skewed towards later stage companies. And this was just beyond a sort of 1 or 2 year effect. This was like a long-term observable pattern. We'd also observed that the portfolio frankly become a bit narrow in terms of the range of exposures. So the most significant process enhancements we did, we dropped in a portfolio construction group to better manage the portfolio. And we came up with a framework to think about the stages of maturity of these companies. And that really breaks the stages of growth up into 5 clear cohorts. And for those earliest 2 cohorts, those companies will be frankly the most to prove earliest on their path. We've introduced controls to better monitor those businesses, both in terms of the progress and how they carry exposure at the portfolio level. We're really trying to instill better competition for capital at the most early stage when we invest. Alongside that, we had various other rules around portfolio diversification, both across industries and geographies.
Right. So you mentioned that it's getting more diversified. You're perhaps going up the chain a little in terms of profit and cash generative names. Is this a lasting evolution in your approach, or is it going to change again because the very nature of the companies that are coming into your purview are changing?
Well, I would say the framework that we're looking to deploy is a long-term feature that we view embedded in how we run the portfolios. But to be very clear, we have always had significant exposure to profitable companies. Maybe the bit that people have to wrap their head around is we run a much broader spectrum of maturities than I think most fund managers. We go from very early stage businesses to businesses that are beginning to prove themselves, to companies that are really executing at scale and capturing and delivering on that opportunity. So I'd really summarize and make the point that where the changes were made, it was about the very early stage businesses that we invest in and better competition for capital there. That was the signal that we detected and really where we made the changes. I'd also just remind the viewers that we're often labelled as a smaller companies focused trust, small cap to use the sort of industry parlance, but we deliberately don't have a market cap limit on our companies once we have them in the fund. So we can run these to very large positions, and it's making sure that we're best positioned to do that. So yes, it's smaller company investing, but with a pretty big twist.
Right. Just to stay on the note you mentioned there of competition for capital, are you finding the range of companies that want to pitch to you, get your capital, is getting more innovative or less innovative?
No, I think the businesses that we see and the ideas that we come across are as exciting as they have ever been. The innovators and entrepreneurs now, if you go out there, they have access to a toolkit of technologies that is unrivaled. They have not had access to these scaling tools, be it AI, be it cloud compute. These things can unlock growth rates in businesses that we think can frankly surprise people. That is always there, and maybe I just sort of point out that you do get these periods where just the uncertainty generally feels quite high, and people retrench. And if I can just sort of reassure people that the real drivers of progress, that human ingenuity and the technologies, that stuff is very much alive and well.
Okay. You talked recently about, and to use your words, extreme returns, the opportunities for extreme returns in areas such as space, genetics, quantum computing. If you had to pick one or two really good examples from those, what would you talk to the investors about?
Sure. I mean, the largest position in the trust is SpaceX, which to some extent needs no introduction. People get that they have the rocket launch business, and that's about really lowering the cost to put stuff in orbit. And they hope to do that again with the high-profile Starship rocket, again, like an order of magnitude decreasing in costs. Perhaps the other bit more that people don't see is the vertical integration within SpaceX. The Starlink constellation, the ability to provide communications infrastructure, data infrastructure, long-term, the ability to maybe even do fabrication in space, offer private constellations. So yeah, there's a huge amount going on there. We have another business in that space area called Astranis, doing geostationary satellites. Maybe if you flip to the genomics area, that's a very prominent theme for us. And really the theme anchors in many ways around DNA, the ability to read DNA, the ability to write DNA, the ability to manipulate it, diagnose disease with it, and treat it at a therapeutic level. And the largest listed position in the trust is a business called Alnylam. They have a technology that can shut down the production of any protein related to its upstream gene. And they are producing fantastic data that really shows that they can tilt the odds of success around clinical development. They've now got 6 drugs commercially available, and they are opening up this hugely powerful platform and pointing that at now much bigger disease types. So yeah, we think that's got the potential to become probably the highest return on investment platform in drug development. Mm-hmm. The quantum computing area is interesting. You started to see that get a bit more interest. Look, clearly there's lots of excitement around AI and huge opportunities for that. I'm not trying to take away from that, but there's certain areas where AI struggles to go, and that's where you lack data, or you're trying to understand a problem that you don't know the first principles of, or a problem that's just hugely deep and complex. So typically the world in which we can't see the atomic level, the subatomic level, that's dictated by the world of quantum mechanics. And frankly, we don't understand that. To understand that, you need a quantum computer. If you do that, you will understand with intricate detail how drugs bind targets, how bacteria fix nitrogen, how plants photosynthesize. There's a whole realm of things that could be unlocked by that.
So, and this is, you're talking about Psi Quantum now, which is your second largest holding. Is that your main player in this quantum area?
Yes, we've looked at several players in the area. The thing that really appeals about Psi Quantum is they are taking existing scalable and workable technologies, in this case silicon photonics, so the type of capabilities that are used in the silicon industry, in the laser industry, in the communications industry, and they are taking those systems and they are making them quantum. I mean, many other players in this area, they are probably best described as physics experiments trying to make something quantum and only then think about making it scalable. So we think increasingly the validation that Psi Quantum is achieving, both from, say, the US defense agencies, the Australian government, they are announcing plans to build large-scale quantum centers. They've attracted, I think, the best part of about $1.5 billion in funding to do that. So the plans to have a commercially available quantum computer, I think by about 2029, if not sooner. These, I think, are far sooner timelines that many in the industry work towards and think, frankly, is possible. You've started to see a lot more announcements in the quantum area, so more recently from the likes of Google and Microsoft, and people making progress on the science. And I think there's this sort of converging on an approach of error-corrected quantum computing will have some very relevant real-world use cases. And yeah, we're keen to back Psi Quantum on that path.
Do you think, a more philosophical question, do you think the world is ready for this? We've barely got started with AI, and who knows how that's going to change the world. Are we then going to go straight into quantum computing and have another seismic change be upon us?
For me, it's not about one replacing the other. Look, I think to your point, there's a lot of change coming. AI can deliver upon that. Quantum computing can deliver upon that. Personally, I think that the two technologies actually dovetail together very nicely. You could imagine a scenario whereby quantum computing could unlock first principle science that we don't understand, and you make that scalable and workable through conventional AI-based technologies. They actually synchronize together very nicely. But yeah, together they will solve huge problems that have huge commercial relevance. The interesting thing with Psi Quantum is, you could say this about others in the area, for the people that solve that, how best do you monetize that? And we're often intrigued by companies. It's not just about a technological breakthrough, but that pure tech breakthrough allows you to have business model innovation. You could envisage a situation here whereby Psi Quantum might never actually sell another computer. They might just be offering access and runtime and billing for that, and actually taking the value share in the problems that they seek to solve for their customers.
So yeah, let's talk about the US, because strange things are happening there, and it's on top of all these changes that you described earlier in our interview. There's policy U-turns coming out almost every week on top of this. Does this make life more difficult for you?
It certainly makes watching the news more interesting. Trying to, as I sort of said at the start, maybe trying to make a long-term call around some of these political noise and posturing is difficult, and you can see that the stock market struggles with that. It's really trying to discern what is basically trying to score political points versus what is actually likely to be embedded. You've almost seen an element of some of the narrative has been dialed back recently, and I think stock markets have taken positive signals for that. But yeah, there maybe is a longer term issue around what is the what is the change in shape of the US business environment and clearly stock markets, until they get real comfort with that, we'll have an element of doubt and angst.
Right. And of course, the counterpart to the US, perhaps withdrawing from the world stage, is a lot of people see increasing domination by China in all these technologies. How much of that thought plays into your portfolio construction?
Yeah, we run a global fund. We are always on the lookout for interesting businesses, and the US, it's good at innovation, it's good at entrepreneurialism, but it clearly does not have a monopoly on that. When we've been out there recently trying to find interesting ideas, we've found a very interesting business in Korea doing very detailed inspection of semiconductor chips as they are being made, and increasingly as chips become more complex in terms of the parameters and size constraints they have to work to, and the three-dimensional architecture, you need very intricate inspection tools. There's a business called Park Systems. The more you look, the more you find, and increasingly we think, the ability to find things outside of the US is very much alive as well, as it always has been.
Would you agree with the notion that we are entering the Chinese century, as it were?
Possibly. The thing that's confused me most about the recent period is seemingly the willingness of the current US regime to almost just give up on being the de facto superpower, and almost just putting that back to the rest of the world. That is something that I think I and other investors did not expect so much.
Okay, let's go back to the title of our webinar, and something else you said recently is you've spoken of this being a golden age for ingenuity and engineering. Where does that conviction come from?
From what we see, the companies we engage with, the founders that run them, the product market fit, and how the products of these companies engage with their customer base. Look, again, it's easy to get wrapped up in the negativity and the uncertainty at times like this. But I think if you almost step back, a lot of this can create huge opportunity. And that's really twofold, because you can get very interesting mispricing of long-term growth. And as long-term investors, that always intrigues us. And second would be that the real tenets that we invest in, that entrepreneurialism, the innovation that accrues from that. As I say, the toolkit to do that it's unrivaled. And we are seeing companies out there innovating with that, and constraints breed creativity. We see that all the time. So the fact that the world becomes a little bit more difficult to navigate, you tend to find that innovators and entrepreneurs do not shy away and shirk that. That probably energizes them.
Excellent, yeah. But it's just before we wrap up and come on to some viewers' questions which have come in. It is so stimulating to talk about these amazing technologies, space travel, quantum computing, but projecting them out into profitability to enable your investment decisions seems incredibly difficult. How do you go about doing that?
You're basically trying to scope out the problem that these companies are looking to solve. You are then making an assessment as to the solutions that those companies have and the ability of their management to execute around that. The key thing to really get your head around is scoping out a path to scale. And that involves navigating lots of difficult waypoints, but it also factors in the optionality that may come to very interesting businesses as they scale. We sort of touched on SpaceX earlier on, but it's almost like the poster child for how you can scale a really interesting technology into a huge underserved market and accrue very interesting optionality as you go. So look, we think we can keep finding companies like that. That isn't difficult in this environment.
It's not difficult, but then you've got to choose between A, B, C, and D.
That's where, to my earlier point around having better discipline at the very early stage, when frankly some of these investments can be binary. helping companies navigate that phase and really backing them when they are on a path to scale, on a path to execute. When the risks frankly change, they become more a pure commercialization risk than anything that's a more sort of binary technology. Will we have a product? Will we not?
Right, excellent. Let's go on to some questions that have come in from the viewers.
Sure.
One, inevitably, is about you've seen off the barbarians at the gate, Saba, and what happens now in terms of capital structure for the trust and maybe a capital return?
Yes, so towards, I think it was the back end of last year, the board talked about doing capital returns. They are busy working away with that. There's very little I can sort of update on in terms of that. But the high level discussion was around, I think it was 130 million to be returned in 2025. That is the plan that we're working to.
Excellent. All right. Interesting question come in about SpaceX and Elon Musk. Elon Musk appears to have at least 4 jobs at the moment. There's SpaceX, there's X, there's running bits of the US government, allegedly, and being involved in the crypto business as well.
Yeah.
Is he giving you enough of his time to run this space exploration business?
There's a very deep team behind SpaceX. Elon is clearly the figurehead of that. I think the evidence in terms of the involvement in the companies that you state, I mean, he's the greatest entrepreneur of our generation. He has a bandwidth which is huge. He has been for the last few months doing elements of this sort of government-related project. But I think as an investor in any business, but particularly business of his, you are looking for an alignment of time frame and commercial goals. And I think for me, acknowledging the time constraints that there have been, that bit you haven't had to sacrifice. There is a clear alignment with what he wants to achieve out of SpaceX and what we would like to achieve out of that business. Had that been compromised, then yes, that becomes an issue. But that feels like that hasn't been compromised.
Okay, excellent. Another question. Thank you for talking us through the companies you've been buying and hold in the portfolio. Can you give an example of a company you've sold recently and explain what triggered your decision to exit a company like that?
There would be several. We exited a business called Sutro, which was a small biotech. And that was really one where the portfolio construction group that we newly installed took a view that we frankly could do better in other healthcare businesses that we own. Generally the name turnover has been sort of 10 to 15 names go in and out of EWET a year. That's probably actually been slightly higher the past year. So yeah, as we've really backed the businesses that we want to own and moved on from ones that we don't.
Okay. Another question's come in the context that we've talked a lot about the private companies in your portfolio. What small cap quoted companies are out there, the next generation of those companies that you might like the look of?
One very close to my heart is a UK listed business called Oxford Nanopore. I think that's probably up there with amongst the most misunderstood businesses that we own and I can unearth. I think they have an exquisitely sensitive technology that at its core can sense molecules. Now they've commercially pointed that initially at DNA sequencing, but the platform is far, far, far broader than that. And the ability to use this both in the research lab and academia, but increasingly, I think, in very interesting areas of acute medical need. Personally, I think that will hugely surprise people.
Okay. Another question come in about how investors have to comport themselves, if you like, when investing in a fund like yours, and that's that because of this early stage and private company investment, this creates high beta. Do you think your investors have to be more patient to experience better returns than perhaps in other trusts?
Yes, would be probably the
short answer.
Yeah, we are unashamed growth investors, and that comes with huge opportunity, and it comes with challenges that you will have to see out periods where the volatility and the signals that you can get from stock markets are difficult to deal with. Even in our most successful investments, we have had periods where we are out of sync with stock markets. As an investor, you have to go through periods of that if you want to unearth these very asymmetric long-term returns. Now, I would say there are elements that we've learned from the last few years, and sort of hand on heart, that the volatility that we experienced was higher than we would have liked. Many of the changes that I sort of talked about earlier on were trying to take a more pragmatic view around just how much volatility can we realistically ask shareholders to tolerate in a fund like this. Yes, they're interested in the opportunity, but if the volatility totally kills people in the intervening time, that's less viable. So yeah, we're cognizant of it, but I think people have to understand we are active in part of the market where volatility is a key aspect of it, and at times that can be the opportunity as much as it is the challenge.
Right, so it's a feature, not a bug, as they would say in the tech world.
That's good word,
yeah, excellent. Someone's asking about higher interest rates, lower liquidity, as we might be seeing now. Certainly, we're a long way from the zero interest rates of just a few years ago. Is this good or bad for the type of companies that you invest in?
Look, I would say the interest rate environment is comparatively normalized. Maybe the abnormal point was 0% interest rates, and as an investor, I genuinely have no desire to go back to that world of free money. That creates weird distortions and almost perverse incentives for the innovators, for the entrepreneurs, for the people that back them, and the people that invest in them. It's not a healthy environment when access to funding is so slack, frankly. So to have markets that, to my mind, feel more normalized is healthy.
Right. It's giving a form of discipline to your investment.
Yeah, well, it gives a form of discipline to the whole financial chain, from business creation through venture capital, through growth equity, through businesses listing.
Right. A couple of questions come in about the people that you admire, I suppose, in different ways. One is we've just seen Warren Buffett hang up his keyboard, as it were, and plan to retire from Berkshire Hathaway. A very different investor from you, but who are the investors historically who you've admired?
I admire lots of people. I mean, they can be the people that run the companies, they can be investors. Long admired James Anderson when he was working at Baillie Gifford, and then followed him closely as he's sort of gone on to other things. I think there's lots of hallmarks around just the drive to keep trying to get good at something. Now, you can apply that in investing. I probably frankly see it more often in the companies that we invest in, and just that tenacity and that almost frustration that things can be done some way better. That's a common hallmark across many of the companies that we invest in.
Right. And I suppose a segue from that inevitably leads back to Elon Musk. Is Elon Musk a one-off, or are there other people like him out there?
Are there other people like him? But personally, I think if you look at the evidence and the record, he's unique. I mean, my earlier comment around the greatest entrepreneur of our generation, I genuinely mean that. I think his hallmarks are radical disruption and innovation, almost in areas where people think it's just not possible. And he has proven the ability to do that in electric vehicles, in commercialization of space, and he has this habit of doing it in huge, deep end markets where revenues can be tens, if not hundreds of billions. So it's rare, I think, to find people that can do that once, let alone multiple times. But there's clear attributes within those companies that he's been involved in that we can see in other companies run by other entrepreneurs, other business people, and you can find lots of mission-driven companies. We own another very interesting one called Axon, which is probably amongst the most mission-driven, founder-led companies that we own. You probably know them from the device called the Taser, the sort of yellow alternative to the gun that's often carried by police forces. And their whole mission from the start has been around to make the gun obsolete. They've been expanded into police body-worn cameras. The really interesting bit with Axon is the bit that you don't see. It's all the archiving, the digital content, and the ability to add AI and intelligence into that. And they've come up very recently with a whole host of AI-led programs that help police in a very practical way, the ability to get AI-led incident reports, do real-time language translation, query points of law with a local language model. These are huge applications of AI. So you can find that in many other areas. Not everything has to go through Elon.
Right. Final question, I think this is, and I'm not sure how much this strays into forward-looking statements, but I'll ask you and you can answer on that basis. On a scale of 1 to 10, how confident are you of a positive growth in the fund over the next 5 years?
If we think about the growth of the companies in regards to the revenue and the earnings that they will produce, 10.
Okay.
In the realms of trying to predict share prices, it massively sort of is influenced by the time horizon that you talk to. I don't know if you actually gave me a time horizon in that question. So
5 years.
5 years, yeah, I'd be personally comfortable with that. Towards the upper end, yeah.
Okay. We'll come back in 5 years and find out. Thank you so much for taking part today. It's been a pleasure to have this very vigorous discussion. It is all we've got time for, I'm afraid. So thank you, Douglas, for your time and insights. And thank you all at home who've been watching this and for your questions. We do have more sessions like this coming up, so please keep an eye out if you enjoyed today. And thank you and goodbye.